So we're going to kick off now with a stock market helicopter overview. Now this graphic shows the major world stock exchanges and their sizes and their market value. Feel free to pause the video and look at this in more detail if you wish. But what this graphic is here to show is it's here to show you the size of the stock exchanges in relation to each other in different parts of the world. Now, in the UK, we think of ourselves, and this is where I'm speaking from, the UK, we think of ourselves as the London Stock Exchange. It's been around for a very long time. It's one of the first major stock exchanges in the world, and we consider it to be really big. And indeed it is big. It does a lot of business, and it is in the top 10 worldwide, and it has a market value of 2.2 trillion US dollars, which is pretty big, yeah. But the thing that I want to impress upon everybody is in comparison to that stock exchange, which seems really big, and other stock exchanges around the world, the market opportunity in the US is far bigger. I just want to show you here that in New York, just in New York, we have the first and the third biggest exchanges in the world. US has the biggest market, the New York Stock Exchange, that's the biggest market in the world. And the Nasdaq is the third biggest. The second biggest is Tokyo, if you're interested. But isn't it amazing that one city in one country has the first and the third biggest markets in the world? Yeah, so combined together in just that one city, they are 4 times bigger than their nearest rival, which is Tokyo. What does that mean? The size of that market? It means that if you're looking at the popular indexes in the US, the Dow Jones and the Nasdaq and the S&P 500, if you look at those major indexes and you want to take part in those indexes, which are the most liquid and widely accessible markets in the world, then you need to be thinking about trading in the US. Whatever you think about your own economy and the strength of your own economy, if you want liquidity and you want to be able to get in and out of the market fast, you want to be trading in the biggest market in the world. Now, why is liquidity important? You'll know from the information that I've given you prior to coming on this course that I'm a great believer in just doing things in a very small amount of time per day. And I'm also a very big believer in when the market acts adversely against us in general, we want to get out as quickly as possible. And if we want to trade quickly, and if we want to get in and out of the market as quickly as possible with our investments, if something untoward happens, then you want to be able to get out quick. You want to be able to find a buyer really quick. And the way you find a buyer really quick is that you take part in the most liquid markets in the world, where there's lots of buyers, lots of people, whatever the circumstance, queuing up to buy what you've got to sell. So this is hugely important. And I can't really emphasize this enough. We tend to think too small in the world. We always think in terms of our own area, our own location, and we need to open our eyes and we need to look around the world and see what's going to be best for us, what's going to achieve the best result for us. And I believe investing in these markets is what's going to achieve the best results for us. Now let's start talking about a couple of important terms. The first term is investing and the second term is trading. Let's talk about investing first. When people talk about investing in the markets, they're talking about buying shares and holding them for a long period of time. And they're looking to profit from the long-term gain of holding shares, and they're not looking to profit from any short-term movements in the share price. They're looking to benefit from the longer-term movements. And what that means is, when we talk about investing, we're talking about a passive or a near passive role in the market. You're doing next to nothing in terms of your interaction with the market, and that's traditionally what investing is. Then if we move on to the term trading, we're talking about making money from short-term movements in the market. Now, a definition of long-term and short-term, you can get into all sorts of definitions, but investing is usually about years. Trading's anything from in and out of the market a few times a year to in and out of the market a few times a day. Trading covers a lot of short-term activity. And what trading is looking to do is buy and sell shares for the short term. And what that means is it's not a passive role anymore. You're really taking a very active role in the market in creating and making your profit. So that's investing and trading as terms. Now let's look at the next terminology that we need to understand in the markets, which is what is a stock. So people talk about getting into a stock and they talk about buying shares, and you may think, well, what's the difference between those two things? So what's a stock? The stock is the capital raised by a company or corporation through the issue and subscription of shares. So when you're buying shares, you're actually buying a small part of the stock. All the shares in the market for a particular company make up the stock for that company. All of the shares make up the stock for that company. So the share then is actually a small division of that total ownership of the company. So it's a small part of the stock. So imagine the stock is the whole pie, the whole money that the corporation or company has raised through the issue of its shares, and the share is a little tiny piece of that pie, and all the pieces of the pie make up the stock as a whole. So now we know what a stock is and what a share is and what investing is and what trading is. Then the next thing we need to do is just understand this concept of a stock market. What does the stock market actually consist of? Here's what the stock market consists of. It consists of buyers, it consists of sellers, it consists of brokers, who are people who assist the buyers and sellers, and then finally there's the market or the exchange itself. So the exchange is the bit where the brokers interact with each other on behalf of the buyers and the sellers. So let's just look at a graphic to illustrate that. So let's imagine we've got some buyers here on the left hand side, and then the buyers communicate in the market through a broker. Now that can either be a traditional broker, where in the past you might pick up the phone and talk to your broker and say, I want to buy 200 shares in Barclays Bank or whatever, or it can be what is more common now, which is you have an internet brokerage account where the broker is still there and still takes your selling orders, but basically you control it, you do everything from a screen on your computer or your smartphone or your tablet. You control what's going to happen with your offer to buy in the market, and it does go through a broker, but you don't actually speak to your broker. So it can be physical by phone, or it can be online, which is what I would say is an instant bypass, because although the broker's there, you're not really interacting with them. So that's the broker. So the buyer takes his idea of what he wants to buy to the market, either through physical communication with the broker or via online communication. And then at the other side of the market, we've got sellers, and they too interact with a broker in exactly the same way, either physical by phone, or they have a brokerage account, as I've explained, an online brokerage account, and they more or less have this instant bypass. And then in the middle, we have the exchange or the market itself, and that's a place where the buyers and sellers interact and the trading goes on. So that's your interaction, just like you would have in the old days if you were taking cattle to the market and exchanging it for veg. It's exactly the same principle, but it's just all about the exchange of shares. So buying and selling in the market then. So buyers are the people obviously who want to invest in the market. So they want to invest in some company, they want to invest in the stock of a company, so they buy shares, which is a small piece of the stock pie, in order to invest. Then we have the broker, and the buyer's broker takes the order to the central market on behalf of the buyer. So their broker takes the order to the market on behalf of the buyer. Then when we look at the sellers at the other side, these are the people who want to sell their shares in the market to other people. And their broker, the seller's broker, takes the order to the market on behalf of the seller. And then in the middle, we have the actual market itself, the exchange. And that's a place for buyers and sellers to trade, as we've said. So the orders from the brokers are taken to the stock market. And then where a buy order and a sell order are matched, that means somebody wants to sell at the same price and somebody wants to buy at the same price of the same share in the same company, then a trade takes place in the market. So if we look at that overall process in terms of an actual transaction, it looks something like this. So let's say I want to buy 100 shares of Microsoft, and that's the symbol for Microsoft, MSFT, at $29. Then I place an order with my broker and that's either online or I've rung my broker up and told him this and said I want to buy them. And then let's say there's somebody at the other side who wants to sell 100 shares of Microsoft at $29. They communicate that through their broker, and those orders go to the central market. And in the central market, there's an order there for 100 shares of Microsoft to sell, and there's an order for 100 shares of Microsoft to buy. And because those two things match, there's then a trade. So that's how the mechanism works, and I hope that was a good explanation for those of you who haven't seen the stock market before to know how this interaction takes place in the market. So what's the stock market used for then? It's a way for companies to raise capital. We said that if companies want to raise capital, they can float some shares on the stock market in form of a stock. So they say, we want to raise some money, we want to raise this much money, and we're going to split that down into shares of this amount, and then people will buy those shares, and that brings money into the company. For a private investor, it's a way for people to invest in companies as a part owner. So if you think of some of the size of some of these massive companies on the stock exchange, it's not something that you couldn't go to that company and say, yeah, I've got $1,000 that I wouldn't mind investing in your company. Would you take that and let me have a share of your profits? Because the company can't possibly interact with all those different forms of people. So what actually happens is it becomes a way for not only the companies to raise capital, but it becomes a way for smaller investors to invest in companies that they otherwise wouldn't be able to invest in, but they can invest in them as a part owner. And then once those shares are actually in the market, the company has already raised its money. All the company does after then is pays a return to the people who have originally bought the shares. But because those shares are now an asset, they have an income coming in from them because dividends get paid on them, then what happens is people will trade the company shares depending on how well the company's doing and the dividends it's paying out and its outlook for the future. So that's what creates the market where people are buying and selling shares and the shares are changing price. If we want to take part in this market, we must know what is happening to the price. If we want to take any profit from the market in any way, shape or form as these shares move in price, we must know what's happening to the price, and we must know how and when to take advantage. And in essence, that's what learning a trading strategy or an investing strategy is all about. You're learning a method where you can take advantage of this movement in price in the stock market. So the final thing to say here is that there are a number of popular investment methods that obviously take advantage of this price movement in the market, and these are those methods. You might invest through a financial planner or invest through your bank. You might invest through your pension. You might trade forex, which is buying and selling currency. Or you might invest and trade stocks, so you're buying and selling shares in individual companies. You might do that as an individual. Or you might trade options, which is the right to buy or sell stock, or you might sell options for income. So those are all things that you can do within the stock market. Some of those are through a traditional financial planner or a fund manager who's managing your pension, and some are individual things. So some of you might have done some individual trading in the past in some of these other methods. But whatever you've done, you've used that mechanism that I've described about the market, what happens in the market. So that's the end of our overview. I hope that's made things clearer for you. If you think maybe I went too fast through that and it's the first time you've looked at this, obviously just go back through the video, watch it again, pause it, write yourself some notes in your workbook so that you thoroughly understand what we've been through there. I'll see you in the next video.